Right now, somewhere between 5 and 8% of your salary is sitting in a retirement account your employer set up, your HR department manages, and a financial institution you probably never chose controls. You put the money in, you watch the balance grow, you feel responsible, and almost none of you have read past the first page of the plan documents. Here's what's on the other pages. Your employer is making decisions inside your 401k that could be costing you between $100,000 and $300,000 in retirement wealth, not through fraud, not through anything illegal, through 5 completely legal mechanisms that are buried in documents written specifically so you won't read them. And the most painful part, most employers aren't even doing this maliciously. They set up the plan once, years ago, optimized it for their own administrative convenience, and never changed it. Your retirement account has been quietly working against you ever since. I'm going to show you exactly what those 5 mechanisms are. I'm going to run the real math on what each one costs you, and I'm going to show you precisely what to do about each one, starting this week. Let's go. Here's what most people believe about their 401k. Your employer offers a retirement plan. You contribute a percentage of your salary, let's say 6%. Your employer matches some portion of that, let's say 3%. The money goes into a tax-advantaged account. It grows over time. You retire with more money than you would have had otherwise. That's the official version, the brochure version, the one HR explained during your onboarding while you were still trying to remember where the bathrooms were. And it's not wrong exactly. The tax advantages are real. The employer match is real. The compounding over time is real. But here's what the brochure doesn't tell you. Your 401k is not a neutral savings vehicle. It is a financial product sold to your employer by a financial institution. That institution made specific choices about which funds to include, what fees to charge, and how to structure the default options, all of which directly affect your retirement outcome. Your employer made specific choices about the match structure, the vesting schedule, and the plan design, some of which benefit you and some of which benefit them. And you, at the moment of enrollment, almost certainly accepted every single default option without knowing that defaults in 401k plans are not chosen for your benefit. They're chosen for administrative simplicity and in some cases for revenue generation. Let me show you what those choices actually cost. Let's start with the number that should make every single person watching this immediately open their 401k account. Expense ratios. Every fund inside your 401k charges an annual fee expressed as a percentage of your invested assets. It is called the expense ratio. On a well-structured, low-cost 401k, you should be paying somewhere between 0.03% and 0.20% annually. That is 3 to 20 basis points. On a poorly structured small to mid-size employer plan, you might be paying between 0.50% and 1.50% annually. Some plans go even higher. That gap sounds small. It is not small. Here's the real math. You have $50,000 in your 401k. You're 35 years old. You plan to retire at 65. That's 30 years of compounding. At a 0.10% expense ratio, which is what a well-run, low-cost plan charges, your $50,000 grows to approximately $850,000 at 7% average annual return. At a 1% expense ratio, which is common in poorly structured employer plans, your $50,000 grows to approximately $660,000 over the same 30 years. The difference is $190,000 from 1 percentage point of fees compounded over 30 years on just $50,000. Now factor in ongoing contributions. If you're adding $500 a month to that account over 30 years, the fee gap between a 0.10% plan and a 1% plan grows to over $300,000 in lost retirement wealth. Your employer didn't steal that money. The financial institution running your plan didn't steal it either, technically. They disclose the fees in a document on page 47. in a font size designed to minimize how often anyone reads it. Here's what you do about it right now. Log into your 401k account. Find the expense ratio on every fund that you're invested in. If any fund is above 0.50%, you are overpaying. If the lowest cost option in your plan is above 0.50%, you have a plan design problem, and I'll show you what to do about that in a moment. The target is simple. Find the fund in your plan with the lowest expense ratio. It is almost always a total market index fund or an S&P 500 index fund, and move your allocation there. One decision takes 10 minutes, worth potentially hundreds of thousands of dollars. When you enrolled in your 401k, your employer had to pick a default investment option, the fund your contributions go into automatically if you never make an active choice. Federal law requires employers to use what's called a Qualified Default Investment Alternative, a QDIA. The law gives employers three acceptable options for this default: a target date fund, a balance fund, or a managed account. Here's what most employers chose: target date funds. Target date funds are inherently bad. The concept is logical: a fund that automatically shifts from aggressive growth investments to conservative bonds as you approach retirement. You pick your retirement year, the fund does the rest. The problem is not the concept. The problem is the execution, and specifically the fees. The average target date fund inside an employer 401k charges between 0.10% and 0.75% in expense ratios. That's fine on the low end, but here's what most people don't know. Target date funds are funds of funds. They are funds that hold other funds, which means you're paying the expense ratio of the target date fund on top of the expense ratios of every underlying fund it holds. The total cost is often higher than what the headline number shows. And then there's the glide path problem. Most target date funds shift to a very conservative allocation, heavy in bonds, starting around 10 years before your target retirement date. If you plan to retire at 65 and you're currently 55, your fund may have already started moving your money out of growth assets into lower returning bonds. On a $300,000 portfolio, shifting from 90% stocks to 60% stocks 10 years before retirement reduces your expected growth rate by roughly 1.5 to 2% annually. Over 10 years, that conservative shift costs you approximately $60,000 to $90,000 in foregone growth. For most people, especially those who will continue spending down their portfolio for 20 to 30 years after retirement, this shift happens too early and too aggressively. What you should do: look at your current 401k allocation. If you're in a target date fund, find out the expense ratio and check the current stock to bond ratio. Compare it to the lowest cost index fund available in your plan. For most people under 55, a simple, low-cost total market index fund will outperform a target date fund over a 20 to 30-year horizon, with lower fees and higher growth exposure. This one is the most misunderstood benefit in all of corporate compensation. Your employer offers a 401k match. Let's say they match 100% of your contributions up to 3% of your salary. On a $70,000 salary, that's $2,100 in free money every year. You contribute $2,100, they add $2,100. You end up with $4,200 going into your account annually. Free money. Everyone says take the full match, and they're right. The match is the best guaranteed return in personal finance. A 100% immediate return on your contribution beats any investment. But here's what nobody tells you about the match. First, the true match formula is almost never what it sounds like. We match 100% up to 3% sounds generous, but here's an alternative structure many employers use. We match 50% up to 6%. Both structures result in the same maximum employer contribution, 3% of salary. But the second structure requires you to contribute 6% instead of 3% to get the full match. If you contribute only 3%, which feels like the right number because it matches the advertised percentage, you only get a 1.5% match instead of 3%. You left half the free money on the table. And the employer designed the plan knowing that a meaningful percentage of employees would do exactly that. Second, and this is the one that genuinely surprises people, the match might not actually be yours yet. This is called the vesting schedule, and it is the mechanism by which your employer legally retains the right to take back their matching contributions if you leave before a certain date. There are two common vesting structures: cliff vesting and graded vesting. Cliff vesting means you own 0% of employer contributions until a specific date, often 3 years, at which point you own 100% immediately. If you leave at 2 years and 11 months, you leave with nothing from the employer match, 0. Graded vesting means you earn ownership gradually, typically 20% per year over 5 years. If you leave after 2 years, you own 40% of the employer contributions. After 3 years, 60%, and so on. Here is the real math on what this costs. You've been at your company for 2 years. Your employer has matched $4,200 per year, $8,400 total in employer contributions sitting in your account. You're cliff vested at 3 years. A competitor offers you a 15% salary increase. You take it. You leave at 2 years. You just lost $8,400 in employer contributions, plus the 30 years of compounding that $8,400 would have generated. At 7% annual return over 30 years, that $8,400 was worth approximately $64,000 at retirement. You didn't know about the vesting schedule. Nobody told you during onboarding because nobody wanted to tell you. You found out when you called HR on your last day. What you do right now. Find your plan's vesting schedule. It is in your summary plan description, the document your employer is legally required to provide. Look up your current vested percentage. Before you make any job change, calculate the exact dollar value of unvested employer contributions you would forfeit and factor that into your compensation comparison. In 2026, the IRS allows you to contribute up to $23,500 to a 401k annually if you're under 50. If you're 50 or older, you get an additional $7,500 catch-up contribution for a total of $31,000. Most people have no idea this limit exists. Of those who do know it exists, the vast majority contribute nowhere near it. The average American contributes about 7% of their salary to their 401k. On a $70,000 salary, that's $4,900 per year, roughly 21% of the annual maximum. Here's the real math on what closing that gap means. Scenario A. You contribute $4,900 per year for 30 years at 7% average annual return. Final balance, approximately $490,000. Scenario B, you contribute $15,000 per year for 30 years at 7% average annual return. Final balance, approximately $1.5 million. The difference between contributing 7% and contributing 21% of a $70,000 salary is over $1 million in retirement wealth. But here's the part that's actually the hidden trap inside this section. Most employers, especially in small to mid-sized companies, never tell employees the annual contribution limit. They tell you the percentage options. You can contribute 3%, 6%, 9%, 12%. Those percentage options are not the IRS limits. They are the plan's administrative options, and they are almost always set well below the maximum. Some plans don't even offer the option to contribute above 15% of salary. On a $60,000 salary, 15% is $9,000. The IRS limit is $23,500. Your employer's plan design is preventing you from accessing the full tax advantage the government is giving you. If your plan does allow higher contributions, the action is simple. Log in, increase your contribution percentage. If you can't get to $23,500 in one step, increase by 2% today and schedule another increase in 6 months. Every percentage point increase on a $70,000 salary is $700 going into a tax-advantaged account instead of being spent or taxed. This one is not something your employer hides exactly. It's something they actively advertise. Most 401k plans allow you to borrow from your own account. Loan up to 50% of your vested balance or $50,000, whichever is less, and pay yourself back with interest. No credit check, no application. The money is right there. It sounds like a brilliant feature, access to a low-interest loan using your own money, paying interest back to yourself. Here is what actually happens. When you take a 401k loan, the money leaves your investment account and sits in a loan holding account, earning the loan interest rate, typically prime rate plus 1%, instead of being invested in the market. In 2026, that loan interest rate is approximately 8.5% to 9.5%. The historical average stock market return is approximately 10%. So the money is earning roughly 8.5% to 9.5% in loan interest instead of potentially 10% in market returns. That's a small gap on the surface, but there are two hidden costs that make 401k loans genuinely dangerous. First, double taxation. When you contribute to a traditional 401k, you contribute pre-tax dollars. When you repay a 401k loan, you repay with after-tax dollars. And then when you withdraw the money in retirement, you pay taxes again. That loan repayment money gets taxed twice, once when you earn it to repay the loan, and once when you withdraw it in retirement. Second, the termination trap. If you leave your employer, voluntarily or involuntarily, while you have an outstanding 401k loan, the entire remaining loan balance becomes due immediately. If you cannot repay it, it is treated as a taxable distribution. You owe income tax on the full amount, and if you're under 59 and a half, you also owe a 10% early withdrawal penalty. Here's the real math. You borrow $20,000 from your 401k. You change jobs 18 months later. You cannot repay the $20,000. In the 24% tax bracket with a 10% penalty, you owe $6,800 in taxes and penalties on money you already had. Plus, you've permanently removed $20,000 from your retirement compounding. At 7% annual return over 25 years, that $20,000 was worth approximately $108,000 at retirement. A $20,000 loan ended up costing you $6,800 immediately and $108,000 at retirement. The rule is simple. Your 401k is not a bank. It is not an emergency fund. It is not a down payment account. It is a 30-year compounding machine. Treat every dollar in it as permanently invested until retirement, because mathematically, that's what it is. Here is your complete 401k audit in 5 specific actions. Every single one can be done this week. Action 1. Find your expense ratios. Log into your 401k account. Go to the investment options page. Find the expense ratio on every fund you're currently in. Write them down. If anything is above 0.50%, find the lowest cost fund in your plan, almost always an S&P 500 or total market index fund, and move your allocation there. Target 0.20% or below. Action 2. Check your default fund. If you're in a target date fund, look at its current stock to bond allocation. If you're under 50 and your target date fund is already more than 20% bonds, consider switching to a pure equity index fund for higher long-term growth exposure. Action 3. Understand your vesting schedule. Pull up your summary plan description. Find the vesting section. Calculate your current vested percentage and the exact date you hit each vesting milestone. Before any job change, calculate the dollar value of unvested employer contributions you would forfeit and factor that into your compensation comparison. Action 4. Maximize towards the IRS limit. Look at your current contribution percentage. Calculate what percentage gets you to $23,500 annually or as close to it as your budget allows. If you can't do it this month, increase by 1% today and put a calendar reminder to increase again in 90 days. Every 1% increase is permanent compounding working for you forever. Action 5. Never take a 401k loan. If you need emergency cash, that need should be met by your emergency fund. 3 to 6 months of expenses in a high-yield savings account. If your emergency fund doesn't exist yet, build it before increasing your 401k contribution above the match level. Your 401k is the last account you ever borrow from, not the first. Your employer did not design your 401k to make you as wealthy as possible. They designed it to comply with federal law, minimize their administrative burden, and offer a benefit competitive enough to attract employees. The result, in most cases, is a plan with fees that are too high, defaults that are too conservative, match structures that are misunderstood, vesting schedules that are strategically timed, and loan features that are actively marketed to people at their most financially vulnerable. None of this is fraud. None of it is illegal. All of it is disclosed.
in documents you were handed once years ago during an onboarding process designed to get you to sign things quickly. Now you know what's in those documents. Now you know the 5 mechanisms. Now you have 5 specific actions you can take this week to recover as much of that lost wealth as your current plan allows. The 401k is still one of the most powerful wealth-building tools available to working Americans. The tax advantages alone make it worth using. The employer match makes it mandatory. But a powerful tool used poorly is still a poor outcome. Now you know how to use it properly.
If this video showed you something about your own 401k you didn't know was there, subscribe to Ethan Explains Money. Every week, we run the real math on the financial decisions most people make without ever reading page 47. And next week, we're going to show you the one investment account most Americans have never opened, and why it might be the single most powerful wealth-building vehicle available to you right now. See you there.